In this video, we're going to talk about the top 10 undervalued stocks to buy now. Before starting, please do like the video and subscribe to this channel for future updates. Now, here are 10 great undervalued stocks to take into account. Number 10, China Petroleum and Chemical Corporation. The People's Republic's China's Petroleum and Chemical Corp manufactures chemicals and energy sources. Service stations, pipelines, chemical plants, refineries, storage facilities, drilling sites, and coal facilities are all owned and operated by the company. The shares are often unpopular due to geopolitical risk and the focus on environmental, social, and governance, or ESG, investment, which makes S&P a deep value play. The company's vital resources and services guarantee a stable flow of income, and China's quickly developing economy guarantees the continual expansion of the company's sizable market among corporations and individual consumers. The stock trades at a price-to-sales ratio of 0.17, a PE multiple of 5.66, and approximately half of the company's book value per share. Number 9, Foot Locker Incorporated. With more than 6 brands and around 3,000 retail locations across 28 countries, Foot Locker is a leader in youth and sneaker culture, if there is such a thing. In order to better serve customers, the specialty retailer with headquarters in New York is modernizing its business practices by expanding the range of products it offers and emphasizing direct-to-consumer sales channels. Following the shift at Foot Locker, shares dropped, providing investors with a chance to purchase at a discount while the business found its footing. The stock is trading for a low 1.02 times book value and a low 0.35 times revenue, and it has a trailing PE ratio of 4.17 based on last year's estimated earnings. Number 8, ACCO Brands Corp. Nothing is more boring than office supplies, but when you own shares, boring yet profitable can actually imply real excitement. The Illinois-based manufacturer, ACCO, produces a wide range of school and workplace items under the Swing Line, Wilson Jones, 5-Star, and Kensington brand names, among others. Customers can purchase ACCO products from brick-and-mortar stores, internet retailers, warehouse clubs, and retailers of office supplies, including Staples and Office Depot. The business also includes a direct sales team and an e-commerce platform. Revenue increased 7.6% year over year, and the shares currently have a PE ratio of 6.06 and a dividend yield of 4.03%. Number 7, Qualcomm. The name Qualcomm, Nasdaq QCOM, is well known in the semiconductor industry. One of Qualcomm's chip designs can be found in almost every smartphone in existence. Apple has caused controversy by bringing the design of the circuitry of its iPhone and Mac products in-house, but the majority of smartphone manufacturers aren't big enough to have that kind of power. With Google's Android platform powering 85% of all smartphones, Qualcomm continues to dominate common mobile devices. In the next years, as the rollout of 5G mobile networks accelerates, Qualcomm is discovering a wealth of new development opportunities for its products. One is networking hardware, which produces wireless signals and enables connections between many sorts of devices. The automotive industry is also expanding quickly. In a short period of time, Qualcomm went from having almost no sales in the auto business to one that brings in more than $1 billion annually. In the coming years, Qualcomm expects its auto market to grow significantly as technology continues to permeate current automobiles. Qualcomm offers a wide range of technology solutions for the automotive industry, from wireless connection to processors managing cutting-edge driver assistance systems to actual software operating systems. Number 6, Disney. In relation to cloud computing, the Walt Disney Corporation, NYSE-DIS, is a great illustration of a non-tech company that uses technology very well. The corporation entered the streaming TV industry in 2019 with the release of Disney Plus. At the beginning of 2022, the subscription service had 130 million users, plus more than 21 million ESPN Plus and 45 million Hulu users. The number of Disney Plus subscribers, which is promoted as Disney Plus Hotstar in many international areas, is anticipated to reach hundreds of millions within the next few years, putting Disney Plus in direct rivalry with Netflix as the biggest streaming service in the world. Given that investors are already aware of Disney Plus's long-term potential, it's safe to say that it's not undervalued. Nevertheless, the rest of Disney may be. The company's flagship theme park division virtually ceased to generate income in 2020 and was a significant drain on profitability. by the middle of 2021. The same is true of the film industry, since new film releases were postponed for the majority of the year. Number 5, IBM. Tech legend IBM is well known. It began more than a century ago and has undergone numerous changes to accommodate the shifting competitive scene. While cloud computing has become the norm over the past 10 years, the corporation has suffered. However, IBM will soon start a new chapter in its history in an effort to directly address this megatrend. IBM created a distinct company called Kyndryl by the end of 2021 from a sizable piece of its existing business, namely its managed infrastructure segment. What's left is a smaller IBM that is more concentrated on the hybrid cloud business and provides services ranging from building data centers to developing software. The brand new IBM provides support for a sector that is quickly expanding and is made up of both publicly and privately held data centers and cloud service providers. According to IBM, the emergence of cloud computing is opening up a $1 trillion per year global market. Number 4, JPMorgan Chase. JPMorgan Chase, a global leader in retail financial services and investment banking, oversees assets worth more than $3 trillion. It is a banking titan with a negligible presence in many American cities. The bank has a global presence and is quickly growing its clientele, particularly in emerging regions where banking services are not widely available. In China, JPMorgan is extremely engaged. JPMorgan is aware that young consumers are favoring digital banking. It prioritizes the mobile experience and provides a range of apps to aid customers in managing their finances and debt. The business is up against a lot of competition from internet firms looking to get into large financial services sector, but it's demonstrating its capacity to advance. JPMorgan has a ton of other levers at its disposal to promote growth. Through its bank branches, the company can increase credit card issuance, provide advanced services like wealth management, and strengthen client relationships. Inclusion-promoting banking services have been incorporated into the new steady expansion plan. Number 3, Amazon. Pioneer of e-commerce, years ago, Amazon put an end to the discussion about whether its large business could ever be profitable. Every year, it had been fast and consistently increasing net income rates. Amazon might not be the first company that comes to mind when considering an undervalued company, but after all, this stock is still very much in the growth stage. Amazon is still reaping the benefits of the early pandemic boom it saw in the spring of 2020, when everyone was stranded at home and did practically all of their shopping online. Additionally, it continues to generate record earnings while growing at a double-digit percentage rate. A large portion of its profits are being put back into the company to encourage even more growth. Regulator-related worries, however, have emerged. Some are concerned that the company's combined businesses in e-commerce, cloud computing, advertising, and other areas may lead Amazon to follow some of its fellow digital giants into the sights of government authorities. Number 2, Target. Since it's grown its dividend payment to shareholders each year for almost 50 years, Target is a dividend aristocrat. Following a successful year in 2020 during the COVID-19 pandemic's beginning, the business saw an increase in sales in 2021. Target, which is best recognized as a big box retailer, has evolved into a one-stop shop that offers everything from food to essential household items. Target also sells its own house brands in classic department store areas like clothing and home goods. The fact that practically all Americans dwell within 10 miles of a Target shop is the company's true difference. The retailer was able to convert these locations into distribution centers thanks to this. In fact, local retailers rather than distribution facilities handle around 95% of all orders, including many that are placed online and transported to customers' homes. Target offers curbside pickup in addition to a purely online shopping experience, and it is growing its shipped delivery service. Target anticipates investing nearly $4 billion in capital expenditures a year, up from around $2.7 billion from 2016 to 2020. This amount will go toward opening new stores, remodeling existing shops, and enhancing supply networks. The business is dedicated to growing its online business while maintaining a steady dividend payout. Number 1, Berkshire Hathaway. Berkshire Hathaway, owned by renowned investor Warren Buffett, should be at the top of any list of the finest undervalued value stocks. Buffett has successfully acquired and held high-quality firms for many years, making him one of the world's richest people. Berkshire Hathaway underperformed the S&P 500 throughout the 2010s as well as 2020 when the market favored high-growth tech businesses, but that drastically reversed in 2021 and 2022. As value equities began to make a comeback. The largest railroad in the United States, an energy and utilities conglomerate, including a sizable renewable energy section, and several other businesses that span industries from food to apparel, are all owned by Berkshire Hathaway, a holding company. Additionally, Berkshire owns sizable investments in companies including Apple, Bank of America, and Coca-Cola. So what'd you think about our video? Do let us know in the comment box below. Oh, and please like this video and subscribe to this channel for future updates.